trucking, AI, housing, yesterday morning's jobs revision. Hi everybody, it is Thursday, February 12th, 2026. Our episode's headline is Theme, Why Did Markets Fall Today? It's more of a rhetorical question than anything. Some are blaming it on real estate, some are blaming it on trucking and AI. Maybe it's the BLS data sinking in. I really don't know. The stock market generally did fall a good amount today, and it doesn't always need a specific catalyst to do so. This leads us to our second headline that I brought up yesterday, and I want to bring up again because it seems like this sector rotation, the sector signal is crescendoing. It seems like more and more data is pushing into the recession category with negative news about real estate today, financials falling. You can see right here the ETF XLF financials falling 2%, not looking strong at all. Technology getting hit today, going down. This is after many recent large formidable red candles in the triple Qs, the NASDAQ. Today's move down in the NASDAQ was one of the largest we've seen since October. XLE Energies, although still in an uptrend, fell back 1.8% today. By itself, it's not falling apart, but when you combine it in the context of all of these sectors, it just looks like we are pushing from late into recession. Take a look at the three industries that typically do well during the recession, actually having some of their most positive performance. Consumer staples, double plus. Healthcare, double plus. And utilities, double plus. XLP, consumer staples, actually rising, believe it or not, by 0.9% today. Just continuing to rip higher. XLV, although not as strong looking as these other sectors, I want to note that we don't have these big single red candle days that have been dominating the chart. Instead, we see a lot of large green candles. This can signal accumulation, not distribution. While technology, with all of these larger big red candles, is screaming distribution. In other words, unloading. Selling dominating so many days very strongly. And the third sector that typically does very well during a recession, XLU, utilities, continuing to rip higher, going up 1.5% today. Intraday, we were actually up 2.6% during the day in utilities, believe it or not, while the Qs were down 2% today. So this is why my second headline today, sector signal crescendo. The signals are getting louder from the sector rotation. We are pushing our way very clearly into recession according to this signal. Third headline for today, jobless claims came out basically as expected. This report is weekly. It's the weekly jobless initial claims. We ticked down just a little bit to 227,000, and continued claims from the week prior ticked up a little bit. Remember, this data is 1 week behind the initial claims data. Our fourth headline today is a reminder. Many bubbles have already popped. You know, on this show, I've been talking about how the S&P 500 is in a bubble, gold's in a bubble. I don't think everything has popped fully yet, but a lot of things have popped very significantly. Professor Bitcoin, the liquidity oracle, is down about 50% right now. I might as well get the chart out of the way for Bitcoin. This is no longer looking as bullish as it had just yesterday. You know, when we're halfway up this green candle, that's like, okay, yeah, we're probably still in a bull flag, but we're starting to accelerate to the downside. This is not looking so much like a bull flag to me anymore. I'm not so sure we're going to get that leg up to around 80,000 before going lower. It looks like we may just be headed lower at the moment. Bitcoin's not the only thing on discount from its all-time high. It's a little hard to believe this. Silver is down 38% from its all-time high now. That's normally really big news. It's not as big news because of how fast it went up, but you can't call something as much in a bubble when it has already dropped 38%. I have to chuckle because moves like this they're enormous moves. You don't normally get this within a week. Gold also dropping 20% from its all-time high to just the beginning of February, and now sitting about 12% off of its all-time high. Earlier, I brought up the fact that financials and technology typically do poorly during a recession. Well, combine the two, you get innovative fintech, ARC-F, the Disruption Innovation Fund of Finance. We're also down in this about 36%. I wanted to bring up this chart as well because we are in a significant spot on, we're getting close to a significant support zone, a support line that goes back to October of 2023. Hopefully you can see that when you connect all of these bottoms here, we're headed there. And, I'm really, really curious to see if, is this going to be the bottom? Is this the buyable dip? Are we going to rip higher and higher from here? I mean, this line has held up so far. And what if it doesn't? What if we're, going back to the lows that we saw in 2022 or lower? You would need a crystal ball for that one. There's more charts to look at and talk about. Community topics. What moves, if any, did you make today? Robschild sits on hands. Coming up tomorrow, we have the CPI. Even Mr. Market's starting to not believe the government data, in my estimation. We also have tariff updates. I'm seeing more headlines just today regarding the Supreme Court ruling. I know today there were some tariffs on Canada that were overturned. So always more updates on that front. Thank you for watching, liking, subscribing, sharing, commenting, and all of your support. On to the charts. SPX, the S&P 500 dropping by 1.6%. A pretty large move down, and nobody really seems to know why. We got that revision of 2025 job data. That was yesterday. Maybe Mr. Market needed some time to look at that. I don't think it was because of trucking, AI, or real estate things going on. I think this is more exhaustion combined with the fact that liquidity is indeed drying up. Remember, the S&P 500 traditionally has acted as the best the best measure of global liquidity, before Bitcoin. Now Bitcoin has been better at it. With Bitcoin down 50%, by the way, it seems like the path is clear for the S&P 500 to go lower. As mentioned earlier, the triple Q is also down 2%. And like I said earlier, this is after so many of these almost seemingly random days of large engulfing red candles. There's nothing about this that looks very bullish, except for maybe the fact that, we are at the top of a run and we've been consolidating sideways. In a lot of cases, this would normally function as a bull flag, right? But with so much money, so much growth priced into this, all while the jobs market, according to so many resources, is not looking very healthy. The amount of growth priced into these companies has climbed so high, it's forgotten how far it can fall. There are times when, by the way, tech companies become very, very obviously very, very cheap. We're not there. Not right now. Anyway, moving on, RSP, the equal weight ETF of the S&P 500 also fell by 1.3%, engulfing the past 3 hopeful days. When you have an engulfing candle like this at the top, this is typically bearish. This is very, very toppy looking. IWM small caps also fell 2%. Has the VIX topped out here? Is this the end of the volatility? Are people buying the dip tomorrow? I don't know. How can I know? I mean, but it is notable the VIX is above 20, so we are in caution mode now, especially since the volatility of volatility is also closed, the VVIX, over 110. We are in what I consider to be caution zone, not panic zone yet. Above 120 is panic zone. We are in caution zone. The Robschild portfolio did really well today, guys. I'm not going to lie. It's in the description below. I have funds that are basically leveraged forms of TLT. 0Z, it has a little bit longer duration, so it's sort of a higher beta version of TLT. And then TMF, which is actually a leveraged version of TLT. But anyway, TLT rose 1.3% today. Bonds to the moon. I can't say that I'm surprised by this. I've been talking about on the show ad nauseum lately how we've been having very clear divergence in the RSI of higher highs, higher lows all over the place, all while the price has been falling. This is just a textbook bottom in TLT. So we're currently looking very bullish in bonds, especially since the 10-year Treasury note yield, after holding this support from, the bottom of all these candles. This one starts December 11th. It's been acting as support here. We cracked through it to the downside today. We are now at 4.1 in the 10-year Treasury note yield. There were many analysts suspecting very strongly that when we were in this range between 4.2 and 4.3, that this was a consolidation for going higher, and instead we are clearly just falling and falling. And I want to re-add to the conversation that crude oil has not fallen yet. When crude oil falls, I think that it will be pulling the 10-year Treasury note down at a faster pace, and I am expecting fully crude oil to be falling here. Today was a red engulfing day in crude oil. I can't say it doesn't look like it's necessarily falling much lower right now exactly. It's set up to perhaps do so. With an engulfing candle like this, I don't think I would want to be long this market. Just as a quick refresher, when crude oil from September of 2025 was falling and falling, all of a sudden there was problems in Russia. Risk premium shot up, and then we went down and down and down. And what happened? We had risk premium in Venezuela. And what happened? Boom, it went up. And then we were going down and down and down. And what happened recently in the country that I refer to as I was running in the Middle East, problems there. Risk premium shooting it up. And what do we have today? Engulfing some of these candles. The chart might say, hey, maybe this risk premium is overdone. If crude oil falls, the 10-year is likely to follow it further. I want to emphasize that. Obligatory cheer for TLT, my favorite place to be. Anyway, Copper, still Dr. Copper with a PhD in economics, let me remind you, not convinced of anything, still going totally flat in this range between $4.75 and $6. I find it very notable that while the triple Qs looks like it's really falling apart, Nvidia, the king of the stock market, is still hanging out at this high levels. There's still a lot of optimism priced into this stock. It's holding up really well. We do have earnings right around the corner, according to TradingView on February 25th. It could easily be one of those scenarios where if Nvidia doesn't look like it's opened a portal to a infinite gold vault in some other dimension, that the stock has a chance of going down. And just to remind us, it still looks like a heck of a potential head and shoulders top on this. I'm surprised to see credit spreads not widening further. HYG divided by SHI is a proxy I use. We don't get more better data until the morning on the Fed with a high yield credit spreads. As I've been suspecting, if you're following the show, the 10-year break-even inflation rate did drop pretty strongly today. We dropped by 3 basis points back down to 2.29%, a level we haven't seen since the middle of January. This typically falls very quickly during recessions. I think we're in the camp. Sorry, I'm in the camp that I think that's starting right now. But what do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.